Asia markets rally following China's rate cut announcement, and China's auto stocks are unfazed by US ban proposal and high tariffs. And we look at the cost of war of Israel on Israel's economy as several businesses shut. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Chinese stocks rallied on Wednesday after the central bank announced another interest rate cut as part of a series of measures unveiled a day earlier to boost its economy. On Wednesday, the People's Bank of China slashed the medium-term lending facility rate to 2%, down from 2.3%. It's the second cut to the MLF in about 3 months after the central bank cut rates from 2.5% to 2.3% in late July. Mainland China's CSI 300 rose 2.13%, while Hong Kong's Hang Seng climbed 2%. The offshore yuan also briefly strengthened to 6.995 against the US dollar, breaking the 7 level for the first time since May 2023. Meanwhile, other markets in the region were mostly muted, with Japan's Nikkei 225 up 0.21%, while the broad-based topics marginally fell. South Korea's Kospi was nearly flat, and small-cap Kosdaq rose 0.2%. And Australia's main index climbed marginally, rebounding from 2 straight days of losses. Let's get more on this now with Josh Mahoney in London. He's Chief Market Analyst at Scope Markets. Hi there, Josh. Now, firstly, how significant are these measures from the PBOC?
Well, this isn't the first time that we've heard from the PBOC about cutting key interest rates. They are notable. You know, we're talking about the cut to the RRR, so the reserve requirement for banks. You know, that's welcome, but it's to be determined as to whether that's going to help, because the problem isn't necessarily that the banks don't have money. The problem is that people don't necessarily want to borrow that money. And that's what's key here. You know, we have got these stimulus measures in place, but the question mark is, with the fact that we're still seeing deteriorating house prices, which is such a key asset for people within China, whether people want to be in a position where they're going to go out and start spending or investing, that is another matter. But certainly I would say that the most notable thing is the fact that we're seeing so many at once. They have been essentially drip feeding supportive measures in the past. And the fact that we're seeing so many announced at one point in time does highlight a potential step change from the PBOC, where they're potentially going to become a little bit more serious about propping up the Chinese economy.
Right, and China's economy grew by 5% in the first half of this year, but there are concerns that full-year growth could miss the country's target. How is Beijing planning to turn that around, particularly in key sectors like manufacturing and retail?
Yeah, well, I mean, also a lot of people don't necessarily trust the numbers that come out of China. So it may be significantly less than 5%. Again, we've got to come back to the demand side of things, right? I mean, manufacturing, you've got to look at who are these manufactured goods going out to. If it's the domestic Chinese consumer, there's obvious weakness there. If they're looking towards their exports abroad, there's also been relative weakness for manufacturers there as well. In terms of what's happening abroad, there is likely to be a pickup as we move forward, because we're now starting to see interest rates being cut across the globe, and that is expected to see people within, say, the US and Europe shifting from a focus of driving down inflation to a focus of lifting the jobs market, lifting growth, and that should benefit Chinese manufacturers and retailers. But certainly in terms of the domestic picture, it's very difficult to know exactly when we're going to see that uplift, because part of it comes down to the depreciating assets that many of them have within the real estate sector. And at the moment, we're not necessarily seeing that turning point.
Moving on to Wall Street, we saw both the S&P 500 and Dow Jones close at record highs overnight. What's driven this rally?
Well, I mean, it has its footing in the fact that we saw the 50 basis point cut from the Federal Reserve. But ultimately, you know, whether it was 50 or whether it was 25, I think the end game in terms of where we get to at the end of all of these interest rate cuts will be the same. What we have seen recently is the resurgence of fears about a potential recession, but they seem to have eased it. There is a lot more confidence, really, that we're going to be in soft landing territory. And therefore, this is almost the best case scenario, really. Low inflation, a soft landing in terms of the economy, so no recession, and then a central bank that seems willing to go over and above to really kickstart the economy and shift quite swiftly from one side of the dual mandate, which is inflation, towards the other, which is essentially lifting the jobs market. So we're now moving towards a pro-growth period, and people really do look towards this nice environment where we're seeing interest rates being cut without the economic collapse that typically comes. If you cast your mind back to previous occasions where we see rate cuts, that usually happens in the face of a massive crisis that's unfolding. This isn't necessarily the case, and therefore people think this is a good time to be getting back into stocks, as the return that you get from fixed asset investments does start to decline.
All right, Josh Mahoney, Chief Analyst at Scope Markets, thank you very much as always. Meanwhile, Chinese EV shares continue on their upward trend. Car maker stocks have surged despite a proposed US ban. Li Auto, a leader in China's new energy vehicle market, is currently experiencing a strong rally, surging around 8%. Hong Kong-listed NIO climbed 9%, while shares of BYD rose 2.7%. Geely added 3.3%, and Leapmotor jumped 4.35%, reflecting the bullish trend in the EV sector. This surge in Chinese EV stocks comes just days before the Biden administration's new rule goes into effect. The measure will ban vehicles equipped with communication or automated driving systems linked to China or Russia. Aimed at reducing national security risks, the rule targets technologies like Bluetooth, GPS and Wi-Fi, with a particular focus on data collection capabilities, which the US fears could be exploited by foreign adversaries. Despite the ban, its immediate impact on Chinese car makers remains limited. Export volumes to the US are relatively small for Chinese car makers, and many Chinese parts manufacturers have already shifted production to regions like South America. This allows them to continue supplying the US market under trade agreements and bypass tariffs. As stocks surged, the China Automobile Dealers Association reported that dealers have suffered combined losses of $19.5 billion in the first 8 months of the year. To combat broader market challenges, dealers have been forced to sell cars at heavy discounts, reflecting ongoing struggles within the industry. For more, we're joined by Andy Mok in Beijing, Senior Research Fellow at the Center for China and Globalization. Hi there, Andy. Thanks for joining us. Now, how will the US government's proposed ban on Chinese auto parts affect Chinese automakers in the long term, given their current market position and global expansion strategies?
Well, the U.S. market is a lucrative, very large market that is immensely appealing to Chinese automakers and especially EV automakers. But that being said, I think there's not a lot new here with these latest measures, in that as much as Chinese EV makers would love to be in the U.S. market, I think, as you just mentioned, they still have a very, very small presence, and it's more a hope than a reality at this point. So I don't think it will have a very large impact going forward. And actually, I think if these measures continue, it will further isolate the U.S. It's well recognized that China is the technology leader and increasingly the market leader globally when it comes to electric vehicles.
Now, with China's recent policy easing and financial support from the central bank, how do you expect this will impact the growth and recovery of Chinese auto industries, and especially after significant dealer losses this year that we just mentioned?
Well, there's certainly two markets for Chinese EV makers. There's the domestic market and there's the global market. The foreign market has been growing very strongly, especially in places like Europe. And again, despite the latest announcements by the United States, I don't think this is putting a dent at all in the actual growth of Chinese EV makers. Now, when it comes to the domestic market, of course, I think it's well recognized that the government sees the need for moderate support for the economy, but that the challenges really are primarily on the demand side. And I think here automotive purchases, whether we're talking about internal combustion engine automobiles or new energy vehicles like these EVs, that they certainly are suffering from the same I think, lack of optimism that many in the Chinese consumption sector are seeing today.
And given that some Chinese auto parts manufacturers have shifted production to places like Mexico, how might this strategy help them bypass US restrictions and maintain their presence in global markets?
Well, certainly, I think this is one way to get greater access to the US market, and it's places like Mexico, other parts of the world. But I think this is also another powerful factor that is driving the growth of Chinese EV manufacturers all around the world. If we look at a place like Mexico, of course, it can serve as a platform or a gateway to the United States. But in and of itself, it is one of the largest auto markets globally, and companies, especially like the BYDs, are gaining significant market shares, often at the expense of American car companies. So, to the degree that these measures taken by the U.S. are not only about national security but protecting the domestic auto industry, it may not be working as well, certainly in places like Mexico.
All right, Andy Mock, Senior Research Fellow at the Center for China and Globalization. Thank you very much for your analysis.
My pleasure.
Now a quick look at some of the other top business stories from around the world. Inflation in Australia fell to 2.7% in August, its lowest level in 3 years. Government relief for the cost of energy and cheaper petrol prices helped drag headline prices down. Electricity prices fell by a record 17.9% thanks to government rebates, but prices for food and non-alcoholic beverages rose 3.4%. Despite the reading, analysts say the Reserve Bank may not cut interest rates anytime soon. Japanese chipmaker Kioxia is delaying a potential $10 billion public offering as global semiconductor stocks continue to fall. Expected to go public in October, the chipmaker changed its course, expecting demand for their shares to not be enough. The company is the world's third largest producer of NAND flash memory chips, storage devices that keep your data safe even when there's no power. Thailand has launched the first phase of its $14 billion stimulus handout, the digital wallet scheme. It will see 45 million people receive around $305 each. The first batch will go to welfare card holders and disabled people, with the government hopeful that the plan will spur consumer spending. Some analysts say the government's budget is already running dry and termed the scheme as irresponsible. And former FTX crypto executive Caroline Ellison has been sentenced to 2 years in prison. Ellison pleaded guilty to 7 charges, including fraud, after the collapse of FTX in 2022. The judge and prosecutors said Ellison deserved leniency for cooperating with investigators, including testifying against FTX founder Sam Bankman-Fried. Israel's economy is facing tough times. A long war and deep political divisions are taking a heavy toll. The big question is, can Israel recover? Malik Fouda has the details.
Its ongoing war on Gaza has hit Israel hard. The conflict has stretched on for nearly a year, and the economic consequences are severe. The country, already dealing with internal unrest, now finds itself in an even deeper financial struggle. Businesses are closing, tourism is collapsing, and the construction sector is almost at a standstill.
I lost almost 100% of my income. I do not earn right now.
Since October 7, Israel's stock market and currency has plunged. The Bank of Israel estimates that war-related costs from 2023 to 2025 could reach at least $55 billion. Consumption, trade, and investment have all been hit hard. In the last quarter of 2023, Israel's economy shrank by more than 20%, and by the end of the year, it took another downturn by about 6%. Labor shortages are another major issue. Analysts expect around 60,000 Israeli companies to close by the end of the year, and it's made worse by a ban on work permits for Palestinians.
Since the beginning, I received unemployment fee for 6 months, but after that it was finished, and then everyone is on his own.
Tourism, also a key driver of growth, has nearly ground to a halt. Pilgrims and holiday makers are staying away due to safety concerns.
I've been here in the country 13 years and I've never seen anything like what happened. Also, I don't see a reason why I should stay here. I'm here without a job and not making any money. It's a stressful situation.
Meanwhile, Fitch Ratings has predicted that this war could last into 2025. This means more strain on the economy and a bigger burden on Israeli society. The country's credit ratings have also been downgraded by the 3 major agencies. And while Prime Minister Benjamin Netanyahu says the economy will improve after the war, the road to recovery will likely be a lot longer. Malik Fouda, TRT World.
Let's get more on this now with Leila Hatoum, political economist and editor-in-chief at MENA Uncensored. She joins us live from Beirut. Good to have you back on the program, Leila. I want to start with Lebanon. Now, it's going through one of its worst economic crises at the moment. How will the recent attacks further exacerbate the situation there?
Well, as you know, during times of war, all the economies across the region, not only in the country that's inflicted, are impacted, be it negative or positive. When it comes to the Lebanese economy, we had a downturn cycle since 2019, but the economy is resilient because it's an open economy. It's a capitalist system, so it actually goes with the flow. We had 4 rough years to actually get used to the situation, from the economic downturn to the financial crisis that we faced. And we were now getting a breather. The war started in October 2023 and it's lasting for the past year until now. This has put some pressure on some of the Lebanese industries because investments don't come that much when it comes to a war zone. But at the same time, we try to find other ways to bypass it. Remember, also political issues impact our economy. We have not only corruption, but we also have a stalemate when it comes to the government. We have a resigned government that cannot take all the decisions that can help the economy. So add to it the war factor, and I do expect we will have a negative impact going forward, especially if this war expands.
Looking at Israel now, this war has dragged on for almost a year now. How has it impacted key economic sectors like tourism, construction, and others?
Well, as you know, the Israeli economy is reliant mostly on foreign direct investments and tourism at the same time. Tourism is down by, it's almost near zero at the moment. So when it comes to the $21 to $25 billion that it generates per year, it's down to nearly shy of $1.8 billion between 2023 and the end of 2023 and now. So we're talking in 9 months, the tourism sector didn't get in $1.8 billion. They usually get about $21 billion to $25 billion. That's a massive hit. Remember, they also have the agro industry that's in the north. The northern sector is currently being hammered by the Lebanese resistance, basically and the Iraqi resistance from the Golan Syrian side. So this has also halted their agro industry. That has put a massive hit against the Israelis. They cannot import much of their food and beverages and basically fresh produce from other countries because they have put a ban on the produce that comes from Jordan because of the E. coli. And Turkey had threatened to halt all their fresh produce exports to the Israeli entity. So that has driven also the prices up. We have inflation when it comes to food. Food inflation, food prices are up, and then you have other markets that are not basically exporting to the Israeli entity because of the war. Everybody is afraid that their ships would be targeted by the Yemeni armed forces. So that also basically pushed the prices up. Agro-industry is down, tourism is down, the labor market is down because they had kicked out most of the Palestinian workers. They tried to substitute them with Indian workers who don't speak the language. They need the skills that they don't have. And at the same time, you have to remember the Israeli society is racist, so it's not working well for them. The construction sector is down, though they are trying to promote that it's going rapidly up because of the new illegal settlements they're going to build in the West Bank. But this has been halted also because of Operation Summer Camps that the Israelis have launched for the past month and a half. Add to it, basically, their support of the shekel. When they support their own national currency with tens of billions of dollars of packages worth tens of billions of dollars, and it doesn't help at all, that puts a pressure also on the government's budget. So that's finance and economy together, pulling all of the Israeli entity down. You have foreign direct investments pulling back. You have Intel, for example, back in June, stopping its basically investment, $25 billion worth of investment in a semiconductor and chip expansion, construction and expansion manufacturing factory over there in Kiryat Gat. That's also another hit to the Israeli economy and the Israeli finances.
And with the war spilling over to Lebanon, Israel is going to have to expand its war budget. How does it plan to shield its economy from a full-scale recession?
Well, the Israelis cannot, if you're asking about Israel, they cannot shield their economy from a total recession. They are actually down below, like they're going towards that downturn. Their war budget has been doubled since last year. In 2023, it was near $15 billion. Now it's $30.5 billion, if not more. And they're getting financing from the US, but they have to use the money to also buy more weapons. So they have to spend on weapons further and further. Whatever money they get from abroad, they cannot use it for anything else. So their war budget is expanding at the expense of their own internal economy and finances. Their people are suffering. We have unemployment in double digits now in the Israeli entity. The last time we calculated it, it was at 14.8%. That's massive. You're saying that 60,000 SMEs are going to close by year's end, as per economists. But as per our numbers, we expect 80,000 SMEs, small and medium enterprises, to close.
Okay, Leila, we will have to leave it there, I'm afraid. Thank you very much for joining us, as always. Well, that's all your business news for now. Thanks for watching.